So without further delay, let's get started with the next standard. So the next standard that we are taking is Ind AS 12 income tax. Ind AS 12 income tax. Okay. So first thing is the background is, sir, accounting profit and taxable profit will not be same. They will be different, because accounting profit you work out by keeping Ind AS, Companies Act rules, etc. in mind. But however, taxable profit you work out by keeping Income Tax Act of 1961 in mind. So obviously this will not match. So there will be a difference. So to plug this difference only, Ind AS 12 was introduced. And we plug the difference by either creating something called DTA or DTL. For difference, we don't create DTA, DTL. For taxable difference, we create DTA, DTL. Let's say accounting profit, taxable profit. Accounting profit is 1 lakh. Taxable profit, let's assume, is 80,000. Let's say tax rate is 30%. So 1 lakh ka 30% is 30,000. 80,000 ka 30% is 24,000. That means there is a difference. There is a tax difference of 6,000. For this tax difference, we try to bridge by creating DTA or DTL. We don't try to create DTA, DTL for this taxable difference of 20,000. If you just check these two ka difference, it is 20. We don't create DTA, DTL for this amount. We try to plug the taxable difference by creating DTA or DTL. That's it. Oh, that is one. Okay. Then we have something called tax base. So we have, or the two concepts here, sir. Ind AS 12, DTA, DTL creation in Ind AS is based on balance sheet approach. When we did accounting standard 22, here I think in CA intermediate we had the standard, but there it was P&L approach. We used to create DTA, DTL by keeping income and expenses in mind. Okay, so that was using P&L approach, but Ind AS uses balance sheet approach. So we need to check the carrying amount of the asset and tax base of the asset or liability and accordingly create DTA, DTL. Okay, so we need two things for balance sheet approach. One, we need the carrying amount, another one is the tax base. Carrying amount means as per the books, as per the accounts, what is the value? The value as per books, we call it as carrying amount. Tax base means what is the value as per the tax record. So we compare the book value as per the books with the value as per the tax record. Compare that and accordingly do the differences. Okay. Next, if economic benefits are not taxable, then we make the tax base and carrying amount to be equal, meaning no DTA, DTL, we account for this. What do we mean by this? Sir, we create DTA, DTL only for the temporary differences. For permanent differences, we don't do it. Like depreciation. Sir, if you just check accounts, sir, if you check depreciation as per accounts and depreciation as per tax, it will never match, because Income Tax Act gives the rate of depreciation for assets. But in accounts, we don't have any rate of depreciation. We keep useful life in mind and accordingly depreciate. So year on year, the depreciation as per tax and accounts will not match. It will be different. But let's say the asset ka life is 5 years. If you compare for all the 5 years, what is the total depreciation as per accounts? And I would add all the 5 years ka depreciation as per tax, they will be same. Meaning at total level, the difference will not be there. It will be same. If the total depreciation as per accounts, if it is 10 lakh means total depreciation as per tax also will be 10 lakh only. That will not match. But year on year, there will be a difference. Such difference, we call it as temporary difference. Okay, or timing difference we call it. So only for temporary or timing difference we create DTA, DTL. If there is a permanent difference, like we have some disallowances, no, like 40A3 ka disallowance. If as per 40A3, if my memory sounds right, if you're making a payment to a single vendor, to a single person on a single day beyond 10,000, that is disallowed. Let's say I paid, I purchased some office laptop by paying cash for 50,000 rupees. I paid cash to buy a laptop. So that is disallowed as per Income Tax Act. Yes, no, because you made a payment beyond 10,000, correct? Right? Like that. So these we call it as permanent difference. If it is permanent difference, we don't create DTA, DTL. Ind AS 12 does not use the word permanent difference, but the accounting is more or less, the treatment is still the same. Okay. So instead of that, they will say like this: if economic benefits are not taxable or tax deductible, then no DTA, DTL is required for that. So how do you do that? Make carrying amount and tax base to be same. You will have carrying amount, make the tax base to be same so that you don't end up getting DTA, DTL. Like exempt incomes, like agricultural income is exempt as per tax, right? So in this case, what do you do? If you have any carrying, any asset used in agricultural activity, okay, if the asset ka value is, let's say 10 lakh rupees, then make the tax base also 10 lakh rupees so that you don't get any DTA, DTL for it. Because on these activities, we never pay tax. Because even if you create DTA, DTL, it will stay forever like that. So DTA, DTL is created more for the temporary difference, not for the permanent differences. That is one. Okay. All right. Another one is tax as per the cash basis. Sometimes what happens, in this you must have heard about it. Let's say we accrued income. We have some accrued income. So obviously accounting is done on an accrual basis. So we have some income that is accrued, but we have not yet received. Let's say we'll receive this income in the next year. but it's already accrued. So we have to accrued that or accounted this. This accrued income is basically an asset. We have to have recorded this in our books, correct? But you have to pay tax on this when? Let's say tax record says you have to pay tax on this income on a cash basis. That means we will pay tax on this only in the next year. So current year you're showing this asset, but as per tax record, you will pay this tax only in the next year. So that means what? This is a temporary difference, correct or no? Because in the as per accounts, it looks, if you're booked an income means you have to pay the tax in the current year. But in reality, as per tax, you will pay the tax only in the next year. So in this case, what to do is make the tax base to be nil. Make the tax base to be nil because you have booked an accrued income, no? Alright, so accrued income will have a carrying amount. So tax base of this, you make it as nil. So that means there will be a difference. And this is a temporary difference. So on this, you create DTA, DTL today. The next year, this year you create DTA, DTL. Next year you can reverse it like that. Same goes for outstanding expense. So if an expense you have accounted on an accrual basis, but you will get the deduction only when you pay for it. Certain expenses are like that. No, you can claim deduction only when you pay for it. But we don't book the expense on payment basis or cash basis in accounts. We do it on accrual basis. So that means this is an outstanding expense. So outstanding expense is a liability. So the liability in your books will have a carrying amount. But you will get the tax benefit on this only in the next year. So that means what? Again, this is a temporary difference. So make the tax base in the current year of this outstanding expense to be 0 so that you will end up getting some DTA or DTL like that. Because we are creating DTA, DTL here using not income approach, but using balance sheet approach. Like that's the reason. I'll tell more about this in a bit, but that's what this particular means. And one more thing is, so on all taxable timing difference, you create something called deferred tax liability. Or on deductible timing difference, we create something called deferred tax assets. On carry forward loss, you create DTA. On MAT credit also, you create deferred tax assets. If at all they ask you as an MCQ, you can remember that. Okay, sir. And I told you an equation. What is that? How to create DTA, DTL? It's driven by an equation. One you remember, that's good enough I told you. Let's say for the first assets. For asset, what is the equation? If the carrying amount of the asset, if it is greater than tax base, if carrying amount of the asset, if it is greater than tax base, then you will get something called taxable timing difference and you need to create deferred tax liability. You don't have to write this in every question, okay? But if at all they ask what sort of a difference is this, then you need to remember. Easy to remember. Deferred tax liability means you have an obligation to pay tax. Hence, on all taxable timing difference means it looks like you have to pay more tax. So on taxable timing difference, you create DTL, okay, like that, okay? So if carrying amount of the asset, if it is greater than tax base, you create deferred tax liability. How will it arise? Look at this small example. Let's say original cost of the asset is 10 lakh. Depreciation as per tax record is 1 lakh. Depreciation as per books is 80,000. Okay. In the first year. This is in year 1, let's assume. Okay. That means, can you tell me what is the carrying amount of PP as per books at the end of the year? You bought it for 10 lakh. You depreciated it by 80. So the carrying amount has become 9,20,000 at year 1 ending. Similarly, what is a tax base? Tax base means value as per tax record at year end. Okay. Because this value is at year end. No? Similarly, calculate tax base of this asset at year end. You bought it for 10 lakh, that's the same. You depreciated as per tax at 1 lakh rupees. So the tax base at year 1 ending is 9 lakh. Is it same or different? Different. So this is an asset. So what is the equation? If carrying amount of the asset, if it is greater than tax base, you create deferred tax liability. How much is the difference here, sir? 9,20,000 minus 9 lakh is 20,000 is the difference. On the difference, will we create DTA, DTL? No, you'll take the tax rate, which will be given to you in the question. Let's assume it is 30%. So on 6,000, you will create DTL in this particular case. Okay, this is as per the equation. Now, if you want to analyze it, actually, it's easy to understand the logic with the help of expense income method. So let's understand it from expense income method. This you use it only for your understanding purpose. In case you forget the equation, you can use your logics and accordingly construct your equation. Now, logically, you think. Now, sir, you pay tax as per the tax record, correct? You pay tax on the taxable profit. Taxable profit, you arrive as per the Income Tax Act provision. Now, sir, what is depreciation as per account? What is the depreciation as per tax? Depreciation as per tax is 1 lakh. Depreciation is an expense. Due to expense, what will happen to your taxable profit? Depreciation, you will be able to claim it as a deduction. It's an expense. Due to this expense, taxable profit will reduce. Okay. Now check, sir. As per tax, the depreciation is 1 lakh. As per accounts, depreciation is only 80,000. So compared to accounts, tax is having higher depreciation. Is my statement right? Compared to accounts, tax is having a higher depreciation. How much? 20,000. That means expense, no, sir. Expense as per tax record is more by 20,000. Compared to accounts, tax record is having an excess depreciation or extra depreciation or more depreciation of 20,000. Yes. Okay. Understand its implication now. Sir, if expense is more as per tax record means taxable profit will be less. because if expense increases means profit will reduce. So if expense as per tax is more means taxable profit in the current year will be less. Yes, based on taxable profit only you pay tax. If taxable profit is less in the current year means the tax that you pay in the current year also will be less. If taxable profit is less in the current year, the tax that you pay in the current year also will be less. But you know, sir, these are permanent difference or temporary difference? These are temporary difference. Year on year, there will be differences. After a few years, this difference will get sorted out. It will be nullified. That means, though in the current year you paid less tax, in the future years, you have to pay more tax because this is a temporary difference. In the current year, you would have paid less tax, but when the difference gets reversed, in the future years, you have to pay more tax. That means if you have an obligation to pay more tax means what will you create? If you have an obligation to pay more tax in future, you will create deferred tax liability like that. So it's easy to understand it with the help of from the expense income angle, but in the examination, you'll always present it under balance sheet approach. And the balance sheet approach works on this equation. Carrying amount of the asset, if it is greater than tax base, you will create deferred tax liability. Or if you want, you can also look at this. This is also probably a better example. Accrued income. What commission income is accrued, sir. Let's assume. So what is the journal entry you will pass? Excuse me. If you have received the commission, you'll write bank to commission. If you have not received commission means you'll write accrued commission account debit. Accrued commission account debit to commission account. Correct? Okay. Let's say this is 10 lakh rupees. Accrued commission is 10 lakh rupees. Okay. This commission is an income. It will be transferred off to P&L. And deferred tax liability, we don't create from income expense angle. We create it from asset liability angle. So this is an asset. Okay. Okay. So that means what is the carrying amount of this asset? The carrying amount of this accrued commission, which is a asset, is 10 lakh rupees. But tax record says this is in year 1. Okay. What income tax act says is you have to pay tax on this. You have to pay tax on this commission on a cash basis. Meaning you have to pay tax on this income only when you receive. Okay. This year, have you received? No, it's only accrued. So this year you have to pay tax. No. When will you receive this commission? Let's say you will receive this commission in the next year, second year. You will receive this commission income in the second year. That means when will you pay tax to the government? In the second year. Correct? So in the second year, you have to pay more tax. In the second year, you have to pay more tax. So you have an obligation to pay more tax. So if you have an obligation to pay more tax, what will you create? Deferred tax liability. You have to create deferred tax liability in year 1. Okay? Yes, no? Correct? In the current year, you have accounted. You accounted the income. But as per the Income Tax Act, you have to pay tax on this only when you receive this income, and you are expecting to receive this income in year 2. That means you will pay tax to the government only in year 2. Now you are in year 1. So in the future years, that is in year 2, you are expecting to pay more tax means now you have to create deferred tax liability. Yes. Now bring this equation here. What is the tax base of this asset? As per the tax record, can you account to this income? Because you can't account this income. Why, sir? Because tax works on a cash basis, sir. There is no accrual concept for this. Yes, no? That means what is the tax basis of this asset? 0. That means is there any difference, sir? Yes, there is a difference. How much, sir? Difference is 10 lakh rupees. Sir, do we create DTA, DTL on the difference or on the taxable difference? Taxable difference. So take 10 lakh and multiply tax rate, which is 3 lakh. So what do you need to create? Look at the equation. What does the equation say? There's an asset, right? If carrying amount of the asset, if it is greater than tax base, if carrying amount of the asset, if it is greater than tax base, what do you need to create? Deferred tax liability. Just like that, when you thought also, what do you need to create? Deferred tax liability. So in case if you forget, you can remember this accrued income as an example and construct your equation. I think it's not so difficult to remember also. Yes, no? Yes. Carrying amount of the asset, if it is greater than tax base, create deferred tax liability like that. Okay, sir. Fair enough, sir. Okay. Or if you want, you can construct it for outstanding expense also. Let's say one expense is outstanding. That means what is the journal entry you will pass? Excuse me. Expense account debited to outstanding expense account. Okay. So outstanding expense, let's say this is 5 lakh rupees. Okay. All right. So that means what is the carrying amount of outstanding expense? You've already booked. This means the outstanding expense is a liability. Carrying amount of outstanding expense is 5 lakh. So this is the liability we are working out. Okay, people. All right. So, but what income tax acts, you have already recorded this expense and outstanding expense in your books in the accounts in the year 1. But income tax act record says you will be able to claim this deduction. This expense deduction you can only claim when you pay this expense. Now, right now, have you paid? No, it is only accrued. You will pay it in the next year. That means income tax act says I will not give you the deduction now. I'll only give you the deduction when it is paid, which is expected to be paid only in the next year. That means what is the tax base of this asset? Tax base of this liability? 0. Okay. Now think logically. Forget about the equation. Think logically. So this expense you have accounted it now as per accounts. But can you claim deduction of this expense as per tax in this year? No. You can only claim it in the next year. So next year when you claim the deduction, what will happen, sir? Your profit will reduce, right? When you get the deduction, the profit will reduce, so the tax will reduce. So when you get the deduction in the next year the tax will reduce. Yes, no. Next year the tax will reduce means you have an obligation to pay more tax, or it looks like you already paid more tax. It looks like you already paid more tax. That means you need to create what for this? You need to create deferred tax asset, because in future year your tax obligations will reduce. So if your obligation to pay more taxes there means you create deferred tax liability. In future if your tax is expected to reduce means you create deferred tax asset. That is the logical way. Now equation way. What is the equation? Carrying amount of the liability is 5 lakh. Tax base is 0. So you obviously have a difference which is 5 lakh. So what was the equation for asset, sir? Asset ka equation was, if carrying amount of the asset, if it is greater than tax base, you will create deferred tax liability. For liabilities, it was ulta equation. If carrying amount of the liability, if it is greater than tax base, then you will definitely create deferred tax asset. Not to the extent of 5 lakh, but on the multiplied tax rate on this, which will be 1.5 lakh. Like, so if ideally you are expected, it's better to remember the equation. If you forget it, you can use these sort of workarounds and construct your own equations to remember by. Okay, sir. All right. So this is about assets and liability. One you remember, that's all. Other things automatically you can construct. Okay, there are 2 equations for asset, 2 for liability. One if you remember, automatically you can go on reversing and accordingly construct your own equations. Okay, that's one. Next is deferred tax liability. Sir, you create deferred tax liability on all taxable timing difference. On all taxable timing difference, you create deferred tax liability except few things. One is goodwill arising on account of business combination. Another one is initial recognition of assets and liability, which neither affects accounting profit nor affects taxable profit, and which is not a business combination. Like this. This is the definition. You create deferred tax liability on all taxable timing difference except goodwill arising on account of business combination. So why don't we create deferred tax liability on goodwill, sir? One is this. Okay, let me take a small example. Let's say PC is 10 lakh rupees. NCI is, let's say, 0. Okay, fair value of net asset is, let's say, 7 lakh rupees. That means how much will you get, sir? You will get a goodwill of 3 lakh rupees. Correct? What is the journal entry you will pass for this? Can you tell me? When you do a business combination in consolidated financial statement, you will write net assets account debit 7 lakh, goodwill account debit 3 lakh, to cash, whatever cash or bank or however you have paid that PC. To bank I will write maybe. This is the PC element, which is 10 lakh. This is the journal entry you will pass. Correct, sir? Now, if you create goodwill, obviously goodwill is accounted as per books, as per Ind AS 103. It will not have any tax base, right? So that means what, sir? Goodwill ka carrying amount is in this equation 3 lakh. Its tax base will be 0. Carrying amount of the asset is greater than tax base means you need to create deferred tax liability. Let's say tax rate is 30%. That means you have to create deferred tax liability 90,000. If deferred tax liability, if you create, what will happen? You check. If you create deferred tax liability means you need to account it, right? So where will you account it? It will come in your net assets. That means net asset, sir, will not be 7 lakh. Net asset will not be 7 lakh because you have to account one liability now. If you have to account one liability means net asset will reduce. That means net asset will reduce by 90,000 and it will become what, sir? It will become 6 lakh 10,000. Okay, but PC is still 10 lakh only. Correct, sir? How do you get goodwill now? Now goodwill you can't record 3 lakh. If you record goodwill, journal entry will not match. First of all, how did you get goodwill? You got goodwill as a balancing figure. Yes, no? You got goodwill how? You took PC, which is 10 lakh. NCA was not there. Then you reduce net assets. Now net asset is not 7 lakh. Net asset has become 6 lakh 10,000. Now if you take 6 lakh 10,000 and work out goodwill, goodwill is not 3 lakh. It has become 3 lakh 90,000. So that means what, sir? If you account deferred tax liability, goodwill from 3 lakh, it will become 3 lakh 90,000. Again on this 3 lakh 90,000, if you again account deferred tax liability, again goodwill will change like this. So it will run in loop. So that's the reason we say goodwill arising on account of business combination do not recognize deferred tax liability. That's one. Because goodwill is arrived as a balancing figure. That's the reason. That's one. Second one is initial recognition of assets and liabilities, which is neither affects accounting profit nor taxable profit, and it is not a business combination. What it means is permanent difference. AS 22 simply said for permanent difference, don't recognize DTL or a DTA. Ind AS is giving fancy definition. This is that. What this line simply means is it's a permanent difference. If it is a permanent difference, don't recognize DTL. So what is that permanent difference? Initially only if you have any permanent difference, don't recognize DTA or for that matter DTL. What is the difference? Check here. Sir, you purchased a plant and machinery for 5 lakh rupees, but by paying cash. You do not pay through check or DD or banking channel. You paid cash. Okay. So in accounts, simply you will pass the journal entry, plant and machinery account debit to cash, 5 lakh, 5 lakh. I mean, yes, no. So what will be the carrying amount of this plant and machinery? 5 lakh. Correct. But as per tax record, this is disallowed because you're not supposed to pay cash beyond 10,000 to a single vendor on a single day, but you paid 5 lakh. That means this is disallowed. Yes, no. That means you'll not be able to claim any deduction on this. Correct. So this is what? Temporary fix or it's a permanent fix? You violate it. So that means you have to suffer the brunt. Correct. No. You have to take the hit. Yes. So that means this is a permanent difference. That means as per Income Tax Act, you will not get any reduction on this. So this is a permanent difference. So on such permanent difference, if you have, no need to calculate DTA or DTL. Okay. And few other things will be your scientific research equipments and all. You get more than 100% depreciation, 200% or 300% something and all is there. No? Correct. You buy 1 lakh worth of asset, you will get 2 lakh depreciation. All that is there. No. So all that is what, sir? Permanent difference. For such permanent difference, DTA DTL is not required to be accounted. Initially only if you have such permanent differences, no need to create DTA DTL for them. That's what they're trying to say. Okay, now, but initial recognition of assets and liability except business combination. That means what does it mean? So on business combination, you have to recognize DTA DTL because why, sir? Sir, on business combination, let's say carrying amount of subsidiary ka assets. Subsidiary ka net asset is 1 lakh. In business combination, will we record subsidiary ka net asset at carrying amount? No, we will record it at fair value. Let's say fair value of subsidiary ka net asset is 1,50,000. That means in consolidated financial statement, we will show the carrying amount of this asset at what value? We will not record in consolidated financial statement, we will not record subsidiary asset at book value. We'll take it at fair value. So that means what? In consolidated financial statement, the carrying amount of the net assets will become 1,50,000. Correct? So initially only it becomes 1,50,000. But what is the tax base of this? The tax base of net asset is what, sir? As per Ind AS 103, you have to take it over and record it fair value. But tax there is no such provision. So tax base is still 1 lakh. So that means there is a difference. On this difference, you will create DTL because this has come as part of business combination. Okay. If you have done a normal transaction in business combination, if you are getting any differences, record it. Even if you're getting initially also, record it. You should record it. Other than business combination, initially only you purchased an asset or initially only you purchased the liability and it looks like permanent difference. Like here, you purchased the asset initially now, but by paying cash. That means now only it is disallowed. Yes, no. So this is a permanent difference arising at initial stage. For this transaction, you need not create DTA or DTL because this is not a business combination transaction. This is a normal transaction. On all business combination transaction, let me repeat, you need to create DTA as well as DTL if required, if they give you the tax rate. Fine. That is one. Sir, DTL can be created on investment in subsidiary also. If you have any investment in subsidiary, on that also you may create DTL. So why, sir? Sir, let's say you buy an investment in subsidiary for 1 lakh rupees. So, okay. So initially the carrying amount of investment will be what? 1 lakh. Tax base also will be what? 1 lakh. This is initially. You purchased subsidiary company ka investment. You got the control over subsidiary by paying, you got 60% control over subsidiary company by paying 1 lakh rupees. So that is nothing but carrying amount of investment. In consolidated financial statement, you will not show investment. That is fine. I'm talking about SFS perspective. Standalone financial statement. So you will show the investment in your separate financial statement at 1 lakh initially. Tax base is also 1 lakh. Okay. Later on, what does Ind AS 27 says? Ind AS 27 says later on this investment could be valued at cost model or fair value model. Let's say company is following fair value model and investment value fair value is 1,70,000. That means henceforth they will show the investment. What is the carrying amount of this investment now? If you're following fair value model and if the fair value is 1,70,000, carrying amount of the investment will become 1,70,000. But tax base is still 1 lakh because all this provision is not there in tax. That means there is a difference. Initially there was no difference. Now there is a difference of 70,000. So on this difference, should we create DTA? DTL is what we are starting. So as a plain thumb rule, yes, investment in subsidiary company also, if there is a difference, you need to create DTA DTL because carrying amount is greater than tax base. No, so you need to create DTL on this. But under a few circumstances, if you couple of conditions are satisfied, then DTA on this investment need not be created. That's an exception. What is that? One, if an entity can control the reversal of timing difference. If an entity can control the reversal of timing difference, and if it is highly probable that this difference will not get reversed on foreseeable future, if both are satisfied, means on this you need not create DTA. So what does this mean? If an entity can control the reversal of timing difference, sir, first of all, Why will the investment ka fair value increase? If subsidiary has performed well, correct? No. If subsidiary has performed well means subsidiary ka net asset will increase, correct? But suppose subsidiary company declares dividend. Parent orders subsidiary company that you should declare dividend. When subsidiary company, if they declare dividend or if they pay dividend, what will happen to their net assets? It will reduce, because when you pay the dividend, bank balance will reduce, correct? No. Yes. So that means what, sir? Parent can easily control this. Parent company can easily control this difference. Why? Yes or no? Correct. If parent company says the subsidiary company pay the dividend, then fair value of the investment will automatically come down, because subsidiary ka net assets will fall. So fair value of the investment also will fall. If fair value of the investment falls from 1,70,000, again if it becomes 1 lakh, tax base is also 1 lakh. So will there be any difference? No. That means is DTA DTL required? No. So who controls this? Obviously, parent has control over subsidiary company. So can entity control the reversal of timing difference? Yes, if it is parent subsidiary. However, if it's an associate and joint venture and all, agreement should be there. If there is an agreement which says investor has a control over associate ka dividend policies, or joint venture has a priority or he has an influence on the dividend policies, if there is any agreement like that, then we say the entity can control the reversal of timing difference, because this timing difference is basically can be reversed when the dividend can be declared. Because the moment you declare dividend, net asset will fall. Accordingly, investment ka fair value also will fall. That's the reason. So in the problem, you take a call. If they don't mention anything, write the condition. As a thumb rule, you write. You can make DTL on investment in subsidiary, joint venture, associate also. However, DTA DTL is not required if two conditions are satisfied. One, the entity can control the reversal of timing difference, and it is highly probable that the reversal will not happen in future. If both are satisfied, means DTA DTL or DTL on the investment is not required to be done. Okay, this may come as a case study question. I don't see any numerical question on this. Okay. All right. Another one is tax rate. So for DTL, we need tax rate. So which tax rate to take? Take the enacted tax rate. Enacted means the tax rate published in the official gazetted document. Take that. Or if it is substantially enacted also, you can take it. If it is substantially enacted by the end of reporting period, that also you can take it. What is substantially enacted? They've not defined. You need to take it. We have to do an assessment on a case-based basis. Meaning, let's say in India, normally we know, right? If you have to go through all this decision, means first the matter will be put up in Lok Sabha, then it will go through Rajya Sabha, then finally president will put his autograph, then it will be published in the official gazette. This is the process. Let's say in India, I'm assuming, I'm not saying, okay. Let's say if it passes in Lok Sabha, let's say if a particular matter passes in Lok Sabha, then we assume that it automatically passes in Rajya Sabha also, and you get president approval also, because the ruling government, let's say, has a majority in Rajya Sabha. Let's assume like that. Okay. Okay. So if a matter goes through the Lok Sabha, then we assume that the matter will get pushed, or it will be voted favorably in Rajya Sabha also, and ultimately you will get approval from president also, if that is the case. In that case, if you say if the moment it passes the Lok Sabha, okay, it gets a favorable vote in Lok Sabha, you can say it is substantially enacted. The standard does not define what is substantially enacted. You have to take it based on the facts of the case. In your examination, they will use the word it is substantially enacted. If they use the word substantially enacted, you can use that particular tax rate. Okay, what is substantially enacted? Facts of the case, it varies. Okay, next is asset held for sale. If any asset is held for sale, you have to use LTCG or STCG wala tax rate. However, if an asset is held for use, then you will take business income tax rate. If you have any non-depreciable asset like land, then you will use a tax rate on sale of asset. So on land, why will there be any difference, sir? Land, sir, you purchase for 10 lakh. So carrying amount is 10 lakh, tax base is also 10 lakh. So no difference. But that is initial measurement. Subsequently, as per Ind AS 16, you can measure the land at revaluation model also, no? So you can measure the land at fair value. Let's say you went for fair value. You bought it for 10 lakh, but you want to go for revaluation model. And the fair value of the land is, let's say, 15 lakh. That means the carrying amount of the land in your books will become 15 lakh, but the tax base will still be 10 lakh. So there will be a difference, correct? So if you keep the land at cost, if you value the land at cost model only, there will not be any difference. But suppose you go for fair valuation model on land, carrying amount and tax base will not match, because revaluation model is only a concept in Ind AS 16. You don't have revaluation concept in tax. So as per tax base, you will show it at original amount. So there will be a difference. On that you will get DTA, DTL. Okay. So in this case, it's a case of DTL. So you need a tax rate for it. So you on this non-depreciable asset like land, you will use tax rate on the sale of asset. That's what it's called. Okay. Average rate also can be used if multiple tax rates are given, is what they're saying. Okay. All right. Next is offsetting DTA, DTL. Sir, if some components are getting you DTA and some components are getting you DTL, both we will not show off. We net off and show the netted off amount in the balance sheet. And normally to do this net off, we have a couple of provision. One, what Ind AS 12 says is you should have a legally enforceable right to set off and intention to set off. So you should have that right to set off. Like we have no LTCG gains. Can you set off with casual income or another one? Like obviously we have set off and carry forward rules, no, right? So you can't violate those rules. Okay, I don't remember full rules now because my income tax is very, very outdated. Yes. So let's say the set off is not permitted. Like business income, let's say you can't set it off with LTCG. Let's assume. I don't know whether it is right or wrong. If it is wrong, don't comment that he doesn't know and all. I really don't know. Yeah, let me tell that. Yeah, because I don't practice much. I don't look at it. So it's been ages. Yes. So let's say set off provision does not allow it. In that case, what's a DTA arising on account of that income, and in case of business income and LTCG, you cannot set off. You have to show it separately. But if you have a legally enforceable right to set off, like ROU and lease liability, ROU and lease liability comes in hand, no sir. ROU also comes because of lease. Lease liability also comes because of lease. So if ROU is giving you DTA, lease liability is giving you DTL, both need not be shown. Both you can set off. But both is coming as part of the same process. That's the reason. Okay. This is about those provisions. So I think with this, we have completed all the concepts relating to Ind AS 12. Now we have few questions. One moment, sir. I'll quickly check what is the battery. If we have shortage, I'll take 5 minutes break and try to charge it. I think we still have a little time. Okay, let's try to finish off, sir. I've not got any warning signal yet. Normally it gives a warning signal. I've not received that. So probably the Vastu is on our side. Let's try to finish this off. Okay. Okay, question number 10. Let's do it. Or this particular question. Excuse me. An entity is finalizing its financial statement for year ended 31st March 2012. Before 31st March, government announced that the tax rate was amended from 40 to 45%. From 40, it has become 45. Okay. All right. The legislation to amend the tax rate has not yet been approved by the legislature. However, the government has significant majority, and it is usual in tax jurisdiction concerned to regard announcement in the change as having substantial effect. That means indirectly they're saying it is substantially enacted. So this increase in the tax rate is substantially enacted. That means you should use what tax rate? For to create DTA DTL, you should use 45%. But you know what our accountant would have done? He would have accounted 40%, I think. Yeah. After performing income tax calculation at the rate of 40%, okay, the entity has following deferred tax asset. So they've created, the accountant has created DTA DTL on 40%. Okay, that's all it is. Of the deferred tax asset of the DTA, 28,000 is related to temporary difference. This deferred tax asset had previously recognized in OCI. Okay. Of this 80,000, no sir, 28,000 is related to OCI. I already told, and maybe I think one more. I think I had. Sorry. I think I'll before this question. Maybe I'll just quickly do this. Okay, a few more points with that. Sorry, my apologies. Sorry, if you have any share-based payment transaction. Normally in share-based payment transaction, what do you do in accounts? As per Ind AS 102, you book the expense over the vesting period. But usually in income tax, you will be able to claim this deduction only when the shares get vested. Only when the shares finally get vested, no, you'll be able to claim the deduction. Okay. So if you have share-based payment transaction, always create DTA on it. Why, sir? Think logically, sir. In the future years, you will be able to claim the deduction. This expenditure will be allowed in Income Tax Act in future. When they allow the deduction of expenditure in the future as per Income Tax Act, profit will reduce. So future year ka tax will reduce. So in future years ka tax will reduce means obviously you will create what? Deferred tax asset. Because here you will not get a liability, you will get a reserve. So you might be a little confused. That's the reason I've given this note. So on share-based payment transaction, always create deferred tax asset. Because in future the tax amount will reduce. That's the reason. Okay. One more thing is before this question is related to this concept only. That's the reason I remembered. Sir, DTA DTL. No, sir, check the accounting. If DTA is related to OCI item, then recognition of DTA, recognition of DTL, reversal of DTA DTL should happen through OCI only. If DTA DTL is related to OCI, then recognition of DTA DTL, reversal of DTA DTL, everything should happen through OCI only. Usually that OCI is revaluation surplus. You will get DTA only due to this revaluation wala drama. So hence revaluation surplus is the OCI that they're talking about it here. However, if this DTA DTL has arisen due to SPL items, not OCI items, SPL items, then you will recognize and reverse the DTA DTL using SPL only. So the journal entry, you will not directly write SPL, you will use over deferred tax expense. This deferred tax expense is shown in P&L. Okay. Or you can pass the journal entry, SPL, pass journal entry for deferred tax liability. The journal entry here will be SPL account debit to deferred tax liability. For DTA, it will be deferred tax asset account debit to SPL, like that. Or if you want to, if it is related to OCI item, and if you have to create deferred tax asset, the journal entry will be deferred tax asset account debit to revaluation surplus OCI. If you want to create deferred tax liability, revaluation surplus OCI account debit to deferred tax liability, like that. Using those components you created. That is one. Okay. Next is DTA recognition is based on prudence concepts. You'll recognize DTA only if you have enough balance of DTL, because you know that DTL can be set off in most of the circumstance. So DTA is recognized based on prudence and conservatism concept. Left, right, center, don't create it. Always check in the problems. If company has DTL balance already, then they can create DTA, because this DTL and DTA they can set off. So DTA is created one if DTL balance. DTA is created only if this I think I've written same here. This is not DTA. This should be DTL. DTA is recognized only if DTL balance is available, so that you can set off. Our second option is future profit is available. Future profit is available because DTA means there will be a future reduction in tax. Okay, like sir, on carry forward losses, you create deferred tax assets. Why? Because in future may your profits or your tax amount will reduce, right? But in order to set off this loss in future may, you should get profits. If you have loss in the current year means, if you want to carry it forward and set it off, in future may you have to expect profits, correct? Now let's say company has a carry forward loss this year 10 lakh. Next 15 years company feels they will suffer loss only. That means current year ka loss, can they set it off? No, because there is a limit. 7 or 8 years is a limit as per Income Tax Act, correct? No. So next 15 years if company is expecting loss only means this carry forward loss in year 1, can they set it off? No. I mean no need to create DTA in that particular case. So if you want to create DTA, there should be a future taxable profits using which you will be able to utilize this DTA, or some tax planning opportunities should be available which help you to generate some profits like that. So again, this is a theory component may come. So I've just called out. Okay, I think that's all. Yes. Now let's come back to the question. I think this is much related now. So we got to know that we have to use substantially enacted tax rate in this question, which is 45% we have to use. Okay, they have already created DTA and DTL using 40% tax rate, but they have to use 45, but they used only 40. And they said out of this DTA, 28,000, what did they say? They said is related to OCI. Out of this 80,000 totally DTA created, OCI related DTA is 28,000. That means balance will be SPL related DTA. That's what I found out, right? Total DTA is 80,000. And they're saying this 28,000 is related to OCI. Question may they're telling. So in 80,000, if 28,000 is related to OCI means balance 50,000 will be related to SPL, like that. Okay. All right. What are they saying? And they're saying it's due to revaluation surplus. So you need to create the revised amount of DTA detail and pass the necessary journal entry they're asking. Simple, sir. You have to create at 45%. Using 45% tax rate you have to create, but they created only at 40. So differential amount you need to create. That's all. So what is the required amount of DTA? You have to create 28,000. This is a difference, right? In fact, you just we'll do the cross multiplication here. So 28,000 is a DTA for 40%. If the tax rate is 40% means 28,000 is a DTA, but actual enacted tax rate is what? 45. For 45 means how much should be the DTA? That's proration. So how do you get X? 28,000 into 45 divided by 40. So this is a required amount. 31,500 they should have created. When you prorate, you will get 31,500. 31,500 was required, but they created only 28. That means how much more you need to create? You need to create extra DTA for 3,500. This DTA is OCI related. So what is the journal entry? DTA account debit to revaluation surplus 3,500 is the entry you will pass. Same thing you have to do for SPL. SPL, how much DTA they have created? 52,000. So they have created 52,000 DTA by keeping the tax rate as 40%. So if tax rate is 40% means DTA is 52. If tax rate is 45 means how much is DTA? Pro rate. So it will be what? You will get 58,500. So required is 58,500, but they created only 52. So additionally you need to create 6,500. So this is SPL related. So the journal entry will be, you need to create DTA. So DTA account debit to deferred tax expense. This deferred tax expense will be shown in P&L in that name. That's the reason. Okay. Same drama you need to do it for deferred tax liability. Deferred tax liability is 60,000. They did not say deferred tax liability is related to OCI. Nothing they mentioned. That means if they don't mention about OCI, you always think that it is a P&L component only. Okay. So 60,000 was what they've created. But what is required? 60,000 is created by keeping tax rate as 40. For 45, how much is it? 67,500. 67,500 was required, but they created only 60. So additionally, you need to create 7,500. So the journal entry will be, so this is a SPL related item. So you'll, instead of writing SPL account debit to deferred tax liability, we write deferred tax expense account debit to deferred tax liability. This deferred tax expense is shown in SPL only. Okay. So that was this particular question all about. That's okay, over. That's what they've given the entry here. Okay. So if you want, you can find out the taxable timing difference, deductible timing difference also and work it out. It's your call. You can directly prorate and work out like this shortcut, or Institute has found out first the difference and then they have reworked out. First find the difference and then calculate actual. That way also you can work out multiple ways to do it, whichever you feel comfortable. Do it, but do it. That's all. Okay. Next is X Limited prepares consolidated financial statement every year for the year ended 31st March 2018. They've given various scenarios. We need to talk about them. X company we are talking about is preparing CFS. Y is a wholly owned subsidiary of X. They made a loss. Y has made a loss for tax purpose 30 lakh rupees. Y is unable to utilize this loss. So on loss, you create deferred tax asset because in future may your tax amount will reduce. So on always carry forward loss, you create deferred tax asset. But the company is saying they're unable to utilize this loss against previous tax liabilities. Okay, because they're suffering loss after loss after loss. Because you can set off the loss only if you make profit in future. Maybe this company is not expecting to earn profit at all. Income Tax Act does not allow Y to transfer the tax loss to group companies. Okay, Y subsidiary ka loss parent cannot set off. Income Tax Act mein there is no such provision is what they're saying. Okay, great. However, it allows Y Limited to carry forward the loss and utilize again company's taxable future profits. The directors of X Limited do not consider that Y will make taxable profits in foreseeable future. Current year mein they made loss, but you cannot utilize this loss because in the foreseeable future, company will not expect profit they're saying. That means will we create DTA or no DTA is required in this particular case as we cannot utilize it. That's one reason. Next, just before 31st March, X committed itself to closing the division at year end, making the number of employees redundant. Therefore, X recognized the provision of 20 lakh rupees. So you made a provision. It's a employee related provision cost. Some employees you are terminating. No? So it's come as part of restructuring only. So it's a committed cost of restructuring. Can you make it? Yes. So the carrying amount of provision is a liability. So you made a provision in your books for 20 lakh rupees. Okay. Income Tax Act allows the tax deduction of closure cost only when the closure actually takes place. So when you made the provision, closure will happen in future. But so in the books you have already made the provision. But as per Income Tax Act, you can claim this expenditure reduction only when the actual closure happens. That is in future. Okay. Now what is it, sir? In the year ended 31st March 2019, X Limited expects to make taxable profit which are in well excess of 20 lakh rupees. They're saying we'll make enough profit also because DTA is recognized based on prudence. No? DTA is recognized only if you have DTL or if you are expecting to make taxable profits in future. That's the reason they're saying. So they're saying if at all this scenario gets DTA, bindas go ahead and create because we are expecting to earn a lot of profits, taxable profits in future. So you will be able to utilize DTA is what they're trying to say. First of all, let's see. This is a DTA scenario. Oh, yeah, I think so. Provision is a liability. Liability ka carrying amount is 20 lakh. But in the current year, tax base of this is 0 because you will get the tax deduction when the actual closure happens. That's in future. Okay. So that means this is what? So tax base is 0. So you have to create deferred tax asset for it. Why? So this is a liability. What is liability? What is asset ka equation first of all? If carrying amount of the asset, if it is greater than tax base, carrying amount of the asset, if it is greater than tax base, then you have to create deferred tax liability. For liability, it will be ulta. If carrying amount of the liability, if it is greater than tax base, you have to create deferred tax asset like that. Or if you forget the equation, you can always go through the logical method here also. Sir, in tax way, you will get deduction in future. There's an expenditure, right? In tax way, you will claim this expenditure, as a deduction in future. So in the future may, if you claim this deduction, what will happen to future profits? Future taxable profit will reduce. So in future may, your tax payable will reduce. So in future may, if your tax amount will reduce, means in the current year, what will you create? Deferred tax asset like that. That's what I've written over here. Okay, that way also you can decode. Next, during the year ended 31st March 2017, X capitalized development cost which satisfied the criteria. So the TIFRC which we discussed, that criteria was satisfied last year only. So we have booked it already. The total capitalized amount was intangible asset under development was 16 lakh. The project began to generate economic benefits from 1st January. Oh, okay. That means that asset is available for use from 1st January. They're saying. Great. The directors estimated that the project would generate economic benefits for 5 years. Since now is this intangible asset still under development? No, it is. We started using it. We started getting benefit also. That means this is an actual intangible asset now. It is still not under development. Development is completed. So intangible asset is available for use. Okay. From how much amount? 16 lakh. Okay. Okay. In fact, it started generating benefit from which date? 1st January. That means this intangible asset is available for use. Till 1st January, you will show this as what? Intangible asset under development. Okay. And intangible assets under development are not amortized. They are only tested for annual impairment. We have studied this. Yes. You will start amortization on intangible assets only from the day it is available for use. In this case, intangible assets started generating benefits from 1st January, meaning it is available for use from 1st January is what they're trying to say. And our current year is ending on 31st March 2018. So current year, you can use this intangible asset only for 3 months. So carrying amount of intangible asset on 1st January is, there's not intangible asset under development. Directly I've written intangible asset. Yes, because once it is available for use from intangible under assets under development, that is a separate category. You have to push it to normal intangible assets wala category. So 16 lakh is the carrying amount of the asset. Amortize it for 3 months in the current year. Useful life they've given, you will get this much. So carrying amount of intangible asset is 15 lakh 20,000. So the capitalization of intangible asset as per TIFRC and all is there only in Ind AS 38. All this is Ind AS 38 ka drama. Tax does not have this. So tax base is 0. Correct. So that means what, sir? Again, this is carrying amount of asset. Carrying amount of asset is greater than tax base. So what will you create? Deferred tax liability. That's what they're trying to say. The development expenditure was fully deductible against taxable profit in the year. So that's the reason you claim the deduction fully. So, excuse me, it is what? Tax base is 0. So in the current year, you have to create deferred tax liability that way. All the answers I've given, quickly I've written here for showcasing. On 1st April, X borrowed 1 lakh rupees, 1 crore rupees. The cost to X Limited for arranging the borrowing, transaction cost is 2 lakh. Transaction cost, it's a financial liability. What should you do for transaction cost for financial liability? Reduce it. So that means the value of financial liability is what, sir? Only 98 lakh. Okay. Then the loan was for 3-year period. No interest was payable on this, but amount payable, repayable was 1 crore 30 lakh 43,000. So you take 1 crore loan now. After 3 years, you will pay 1 crore 30 lakh. Okay. You're not paying periodic interest. At the end of it, you have to pay a higher amount. That's what they're saying. But we know, as per Ind AS 109 and all, what are you doing is irrelevant. We do substance over legal form accounting. Okay. So we have to find out effective interest rate. What is the effective interest rate? 10%. Based on this, you have to book finance charges or interest. So what is the opening balance of financial liability? Not 1 crore. There is 2 lakh transaction cost, which we deducted. So it became 98 lakh. Book finance charges at what rate? 10%. So finance charges will be 9 lakh 80,000. Is there any payment? No. So closing balance of the loan is 1 crore 7 lakh 80,000. This is the carrying amount of financial liability. Yes. Carrying amount of financial liability is 1 crore 7 lakh 80,000. What about tax base? Sir, in tax base, do you have, this is your amortization cost wala table wala drama. All this is there in tax record. No. You took how much loan? 1 crore. That means as per tax record, loan amount is how much? 1 crore. Yes, that's all it is. All this is there in Ind AS 109 ka accounting drama. It is not there in tax. Yes, so tax is easy. Yeah. All right. So now look, plug in the equations. What is that now? There's a liability. Carrying amount is greater than tax base, but not of an asset, but of a liability. If asset ka carrying amount of it is greater than tax base, you need to create deferred tax liability. For liability, if carrying amount is greater than tax base, you need to create deferred tax asset. So difference is 780. Multiply by the tax rate. I think it's given somewhere over here. Tax rate is 20%, and you'll get the deferred tax asset to be 1,56,000. That is what they told. All the answers they've given over here I've underlined as well. Okay. Yes. Next. On 1st April 20x1, S leased a machinery for 5-year period. The present value of lease liability is 120 crore. Okay. And discount rate 8% and recognized as lease liability, and corresponding ROU asset is the same. Initially, ROU and lease liability is measured at same, correct? No, except a few parameters are not there, which we studied in Ind AS 116. Okay, what is that? Initially, ROU and lease liability will be same. It could be different provided if any payment is made by the lessee to the lessor before the commencement of lease, or if there is any IDC, or if there is any DAC, right? So all of that is there means ROU will change. Otherwise, ROU and lease liability initially will be same only. ROU is depreciated under a straight line method over 5 years. Annual lease rental is 30 crores. Law permits tax deduction on a payment of rent. Sir, as per Ind AS 116, the moment you take on lease, lessee has to record ROU, lease liability, all that. But in tax, there is no all this drama. Whatever rent you are paying, you will claim it as deduction. Yes, no, that's all. It is simple. Correct. Tax rate is 30%. So now you need to calculate DTA ka consequence is what they're saying. Multiple ways to do this. Okay, first I'll show you like this, then simpler way. One is carrying amount of ROU. How much is that? 96 crores. They only given, whereas a ROU, in fact, I think this was the beginning of the year. Okay. We create DTA, DTL at the end of the year and all. So initially lease liability was 120 crores. Okay. That means at the end of the year, how much it will be, sir? In fact, I think they must have given, okay. You have to depreciate ROU. I think, okay, I'm not calculated. That will do it. The ROU is depreciated over 5 years. No? So that means, what is it, sir? ROU initial value will be 120 crores. You would have depreciated over 5 years. So 24 crores is first year depreciation. 120 minus 24 is 96 crores. That's what I've taken over here. The depreciation is shown over here. 120 was beginning of the year value. 1 year you would have depreciated. No. So after depreciated, ROU ka value is 96 crore. So carrying amount of ROU is 96 crore. Do you have any ROU as per income tax record? No. All this is only Ind AS 116 ka substance over form ka accounting. This is there only in accounts. We don't have tax me all this. So tax base is what? 0. So carrying amount, ROU is an asset. Carrying amount of the asset is greater than tax base. So what do you need to create? Deferred tax liability. But take the difference, multiply tax rate, you get DTL. Only this? No, there is lease liability also. Lease liability also you need to find out. How so? Sir, initially value of lease liability is 120 crore. You need to add finance charges. Have they given this one? What is that? Discount rate they've given 8%. So calculate 120 ka 8%. How much is that, sir? 9.6 crores is finance charges. Is there any payment made? Yeah, I think you paid 30 crore lease rental. So when there is payment, this is amortization cost table I'm presenting straight away. Okay, 30 crore is the payment. So reduce it. So 120 plus 9.6 of finance charges minus 30 ka this. You'll get 99.6 as this 99.6. That's what they've shown over here directly. 120 crores is opening balance. Amortization table ko opening balance. Add finance charges. 120 crore ka 8% minus the payment made, which is 30 crore, which is 99.6. So carrying amount of lease liability is 99.6. But we don't have any tax base for this because in Income Tax Act, there is no concept of ROU, no concept of lease liability also. So lease liability ka carrying amount is greater than tax base. So here you have to create deferred tax asset. DTL for 28.8, DTA for 29.88. All of them have come through lease only, no? Instead of creating separately, you can net off. So which is higher? DTA is higher by how much? 1.08 crores. Like this. One way you can work out like this. Or initially only you set off, no? ROU ka carrying amount is 96. Lease liability ka carrying amount is 99.6. So which is higher? This only is higher by how much? 3.6 crores. So directly you can calculate on 3.6 crores only. So take the net amount initially. Tax base is anyway 0. This is your DTA amount. DTA only is more, no? Or meaning this is what, sir? Rather the ROU only is more, right? Rather lease liability is more. Yeah. 3.6 crores is the lease liability ka extra value. Okay. So tax base is 0. Liability ka carrying amount is greater than tax base. So you'll create deferred tax liability on 3.6 crore. So this only you net off initially. Okay, you'll get 3.6 crores. So this is the carrying amount of liability. Tax base of this is 0. So carrying amount is greater than tax base. So you'll create DTA on this 3.6 crores, which will be same 1.8 crore. You can work out separately or initially only you can net off and get the final answer. The choice is yours, the way you want to present it. Okay, I say all this is there in ICA material only. They present it like this. Okay, next, on 1st April 20x1, A acquired 12 crore shares in B Limited by the means of cash payment of 25 crores. So that is your PC. It is a group policy to value NCI in subsidiary on the date of acquisition at fair value. So NCI under fair value method. Okay. Market value of equity shares of B Limited, subsidiary company, can be used for this purpose. We need NCI valuation, no? Fair valuation. So they're saying use market value of the shares. And market value of B ka share is given to be 2 rupees. Okay. Stop here only. How much percentage parent has purchased? 80%. How many shares did they buy? 12 crores. So 12 crore shares is for 80%. Correct? NCI owns how much? We want NCI ka shares. If you want, you can calculate for 100% also, but I'll use shortcut method. Okay. 80% represents 12 crore shares. 20% represents how many shares? So X is equal to what here? 12 crore into 20 divided by 80. That will be what? 3 crore shares. Correct? So that means NCI basically owns 3 crore shares. Parent owns 12 crore shares, means NCI owns 3 crore shares. And what is the value of each share of B Limited? 2 rupees. That means what? This is NCI ka shares. So what is the NCI ka value? Fair value of NCI is how much? This is 3 crore shares. One share of NCI held by NCI has a fair value of 2 rupees. So 3 crore share will have a value of 6 crore rupees. That is what they've taken it over here somewhere. They must have taken, or I have solved it separately. Yeah? Okay, no problem. We'll see. I think here they've taken NCI ka fair value to be 6 crores. Okay, we'll see that later. Okay, this is one NCI ka calculation. We got it. On 1st April 20x1, individual financial statements of B Limited showed net asset of 23 crore. Okay, we got the control on 1st April 20x1 only. This is the date of control. On that day, financial statement showed a net assets of 23 crore. So financial statements will show what net asset? Financial statements will show the net asset at carrying amount, because that's what you show in your financial statements, no? But subsidiary ka net assets, we can't show it at carrying amount. We have to take it at fair value. Okay, I think they'll give that later. Directors carried out a fair value exercise to measure the identifiable assets and liability of B Limited, and following matters emerged. Property having a carrying amount of 3 crore had an estimated market value of 18 crore. Oh, okay, that means they will give you this is the book value of carrying amount of net assets. And in this few net assets ka fair value, they will say fair value is increased or something. So fair value adjustments you need to give. We have done all this in our consolidation, right? So compared to book value, carrying amount of PP, fair value of PP has increased by 3 crore. Yes, no? Carrying amount is 15 crore, fair value is 18 crore. So there is a fair value adjustment of 3 crore here. Similarly, PP, carrying amount, this should be 11 crore, it's a typo, had a market value of 13 crore. So fair value adjustment is, or fair value increase is 2 crore. Inventory cost is in books is 2.5 crore. Inventory is shown in at cost of 2.5 crore means this is the carrying amount. That's what you're showing in your books. What you're showing in your books is carrying amount. The fair value is 3 crore. That means the fair value adjustment here is 0.5 crore. So all assets only, no liabilities. Yes. So these fair value adjustments have not been reflected. So they have not yet done in individual financial statements. Yeah, in individual financial statements, you don't have to do this because fair value adjustments are to be done in consolidated financial statements, which we will do. In consolidated financial statements, fair value adjustments will be regarded as temporary difference. So they're saying don't take this fair value adjustment as a permanent difference because for permanent difference, we don't create DTA, DTL, only for temporary difference. The rate of deferred tax for tax rate they're saying is 20%. Okay. So first we have to find out the carrying the net assets, fair value of net assets. First, let's find out that. Okay, what is the carrying amount of net assets they've given? Okay, or maybe first we'll find out this. We'll do this order only. Okay, so certain assets ka fair value has increased. Do you agree with me? Yeah. Property by 3 crore, plant by 2 crore, and inventory by 0.5 crore. So if you add everything, how much are you going to get? 3 plus 2 plus 0.5, which is 5.5 crore. Yes. So this 5.5 crore, will you account it in consolidated financial statement? Yes, because there's a fair value adjustment, so you will definitely give it. So that means when you give fair value adjustment, what will happen? Carrying amount will increase, correct? Now, the moment you add fair value adjustments to carrying amount, the carrying amount will increase. But all this fair value adjustment is done as per Ind AS 103. Tax base is still the same. Tax base of this will be, it will not be. So let's say, what sir? In tax, all this fair value adjustment is not there. The moment you do fair value adjustment, so carrying amount will be greater than tax base. That's what I've written here. Check. When you do a fair value adjustment. So if you don't do fair value adjustment, carrying amount as per accounts and carrying amount as per tax will be same. So that means there will be no difference. But but you're not taking over the assets in business combination at carrying amount. You're taking it over at fair value. So that means you will take the carrying amount and you will give fair value adjustments. One way to take it over at fair value is like here. Like just to tell you, or maybe we'll take this example only. One way to account this is like here, sir. In consolidated financial statement, should we show property at 15 crore or 18 crore? 18 crore. So one way to do that is directly take over 18 crore. Because fair value is 18 crore, directly take over 18 crore. Or another way to do it is take the carrying amount and add fair value adjustment. Take the carrying amount and fair value adjustment you add. What is the carrying amount? 15 crore. What is the fair value adjustment? 3 crore. You add it. What are you going to get? 18 crore, which is nothing but what? Fair value. This is another way to do. Yes. Either directly take fair value or take the carrying amount. To that you add fair value adjustment. The moment you add fair value adjustment, do you think tax base and carrying amount will be same? No. Due to fair value adjustment, carrying amount will increase, but tax base will remain same. That means due to this fair value adjustment, carrying amount will be greater than tax base. And in this problem, how much fair value adjustments have you made? You made fair value adjustment to the extent of 5.5 crores. That means carrying amount will be greater than tax base. All these are assets. So carrying amount of these assets, I'll use it as probably net assets. Carrying amount of net assets will be greater than tax base by the extent of 5.5 crores. So the difference between the carrying amount and tax base is nothing but 5.5 crores. Do we create DTA, DTL on difference? No, on the taxable difference. Since these are assets, since carrying amount is greater than tax base, we have to create deferred tax liability. So on 5.5 crores, take the tax rate 20% and you have to create deferred tax liability 1.1 crores. First do this. Why? Sir, even deferred tax liability is one asset. And this also needs to be accounted in subsidiary book. When you do Ind AS 103 adjustment, that's the reason first we calculated this. Correct. After you do this, calculate the revised net assets. And we want net assets or we want fair value of net assets. What we really want is the fair value of net assets. So how do you do that? Take carrying amount of net assets. To that you add fair value adjustments. What is the carrying amount of net assets? Initially only they gave, sir. Carrying amount of assets as per financial statement is 23 crore. So take this. To this you add fair value adjustment. What is the total fair value adjustment? We got it here. 5.5 crores. Add this. So ideally net asset should be this much. No. But we also have a deferred tax liability. No. These are all assets. Because of this adjustment, we have to create deferred tax liability also. Deferred tax liability also you need to account. So if you have to account one liability, means net asset will be same or it will reduce. It will reduce. So deduct deferred tax liability, which we already calculated here, 1.1 crore. So revised net asset will become 27.4 crores. Now take this amount and accordingly do your goodwill bargain purchase gain wala calculation. That's okay. So don't directly take net assets because DTA, DTL also will affect net assets. So always in business combination, whenever they give you a tax rate, first find out DTA, DTL, then work out the revised net assets. Okay. So how do you calculate goodwill here? PC portion. How much is PC? How much did we pay? I think they directly gave how much cash? 25 crore cash we paid. So that is your PC. NCI we have already worked out, which is 6 crores. That's what I've given here. I've written in one line. 12 crore, I mean, same presented over here. Okay. 12 crore is for 12 crore shares parent own. That is for 80%. So 12 crore divided by 80% if you do, you'll get the total number of shares in subsidiary company. Okay. In that 20% NCI owns. So we've done that. This will give you, this multiplication will give a number of shares of NCI. And each shares of NCI ka fair value is 2 rupees. Hence NCI ka value will become 6 crore. The way you want to present, you present it. That's fine. You can present like this or in one liner like that, whichever you call. Then deduct fair value of net assets, which we just now got, 27.4 crore. That way you'll get goodwill of 3.6 crores. That's what they asked in the problem. Okay. So how will you calculate on that? That's what they worked out all here. Goodwill is 3.6 crore. That's okay. Last question for the day. Okay. Hopefully iPad is still working on. Thank you. Yeah. Okay. P Limited granted 1 crore shares worth 4 crore for a 2-year vesting period. Okay. So we already discussed this. What is the concept? On share based payment, always create deferred tax asset. Because in Income Tax Act, you will get the deduction only at the time of vesting. When it finally gets vested, you will get the deduction. When you get the deduction, future tax will reduce. That's the reason you need to create deferred tax asset. That's a concept that is getting tested here. That's all. Okay. So vesting period is 2 years. Income Tax Act permits tax deduction on the exercise date. The intrinsic value of the option. So there are 2 ways you can find out, sir. As per Ind AS 102, no, we don't use intrinsic value. There are 2 methods. One is intrinsic value, another one is fair value. Accounting standard allows both. Accounting guidance note. In fact, we don't have any accounting standards. We have a guidance note. Guidance note issued by ICA allows both intrinsic value method and fair value method. But Ind AS 102 allows only for fair value method, which you would have learned in your SFM, right? Black-Scholes model, options pricing model, etc., etc. Yes. So using that only you can figure it out. So Ind AS 102 allows only fair value method, but Income Tax Act allows intrinsic method. So there will be a difference. The intrinsic value of the option at the end at the end of first year, that is 31st March 20x2. So on 1st April 20x1, you gave the plan. At the end of first year, intrinsic value of the option is 1.6 crores. Okay. And at 31st March 20x3, it is 4.6 crores. The increase in fair value option was not feasible, blah, 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 blah. So tax rate is 30%. You need to calculate DTA, DTL. You know that you have to create DTA. Yes, on this, we already told. Because in future, your tax, when you get deduction, your tax amount will reduce. So that means it looks like you already paid the tax in advance. So you need to create deferred tax asset. The question is how much? Sir, what is the intrinsic value? 1.6 crores. The entire intrinsic value, it's like fair value, right? Entire fair value, you will book it in first year only. No, you have to amortize it. Booking of the expenses over the vesting period. What is the vesting period here? 2 years, right? So 1.6 crores is the expense relating to 2 years. So what is current year come? The expense for 1 year will be 1.6 crores. Instead of booking it on a fair value basis, you have to book it on intrinsic value basis. That's all. Because you're going to get the deduction based on intrinsic value. No? So don't take fair value. Take only intrinsic value. Total intrinsic value is 1.6 crore. That is like your total expense. This total expense, you have to book it over 2 years. So what is the expense for year 1? 80 lakhs. Okay. So that means that is the difference. This is the difference. Because on Ind AS, we are following a fair value method, and income tax allows reduction only on the intrinsic value method. And that too, Income Tax Act allows a reduction only when, sir? Only when the option gets exercised, not during the vesting period, during the exercise period. Only when the employee purchases the share he'll buy. So what you have to simply do is find out the intrinsic value, because you get the reduction based on intrinsic value. You'll not get further reduction. Even if you book it on fair value, okay, you'll not get the reduction based on fair value. So that means that will be a permanent difference. To whatever extent you are getting deduction, that only you need to take. So here the value is intrinsic value. Take the intrinsic value. So that is 1.6 crores. But this you have to book it over 2 years, because vesting period is 2 years. So what will be the expense for 1 year? 80 lakh. So that is a difference amount on which you need to book DTA. So DTA is how much, sir? Tax rate, multiply the tax rate. 80 lakh into 30%, which will give you 24 crores. On this 24 crores, you need to book the deferred tax asset. Okay. All right, that's what I've given here. In accounts, you book employment benefit expenditure based on fair value. But Income Tax Act, you get the deduction based on intrinsic value only. So don't take directly intrinsic value and multiply tax rate. The intrinsic value is for 2 years, because vesting period is 2 years over here. So you have to amortize this for 2 years. So intrinsic value 1.6 crores is for 2 years. For 1 year, how much is it? So you have to prorate it, which becomes 80 lakh. So on this 80 lakh, you have to create DTA by using tax rate. That's what we have done over here. Okay, sir. So first year you will create DTA. Okay, so the journal entry will be deferred tax asset account debit. It's not an OCI related item. So you'll simply write deferred tax expense account. So second year, when it gets vested, assuming that it gets vested, what do you do? If the difference is no more there, means you will reverse, because these are all temporary differences. Year on year, there will be a difference. And one fine day, all these are bookish assets. Both DTA, DTL will get closed. So when the shares get vested or exercised in the next year, whatever DTA you booked in 1 year, no, it will get reversed. So reversal mein upas ulta entry you. deferred tax expense account debit to deferred tax asset account. That's all. So till you have difference, you will show DTA, DTL. Once the difference gets reversed, DTA, DTL also should get reversed. That's the overall accounting for, with this, all the questions and the concepts relating to Ind AS 12, we have officially completed. Yes, I know that we took a little extra time today, but I think it's worth it. Yeah.